an unusual tension in early October 2025. Behind closed doors at the Deutsche Bundesbank headquarters, Germany's most powerful financial institution issued warnings that sent shockwaves through European capitals. This wasn't just another economic forecast. This was a final alarm, a desperate signal that the continent's largest economy sees catastrophic cracks spreading through the very foundation of European prosperity. Germany's central bank has broken its traditional silence with unprecedented urgency. The institution that guided Europe through decades of stability now speaks openly about systemic failure. What changed? What terrifying data crossed the desks of Frankfurt's economists that forced them to abandon diplomatic caution? The answer lies in four interconnected crises converging simultaneously, creating a perfect storm that threatens to dismantle the European project itself. The industrial collapse. Germany's engine sputters to a halt. Germany's industrial sector, once the envy of the world, is experiencing its most severe contraction since reunification. The Bundesbank's October 2025 report reveals manufacturing output has declined for 17 consecutive months. This isn't a temporary slowdown. Chemical plants along the Rhine are operating at 60% capacity. Automotive production facilities in Bavaria and Baden-Württemberg have announced extended shutdowns. The numbers tell a brutal story. Industrial orders have collapsed by 23% year over year. Energy costs remain the primary executioner of German industry. Despite 2 years passing since the initial energy crisis, electricity prices for industrial consumers remain 3 times higher than American competitors and double those in China. BASF, the chemical giant that symbolized German industrial might for over a century, has permanently relocated significant production capacity to China and the United States. This isn't temporary adjustment. This is permanent deindustrialization. The Bundesbank's confidential assessments, partially leaked to financial media, describe something previously unthinkable. Germany transforming from Europe's industrial powerhouse into a service economy dependent on financial services and tourism. Volkswagen announced in September 2025 that it would close 3 factories in Germany, the first domestic closures in the company's 88-year history. 30,000 jobs vanish with those closures. Siemens, Bosch, and Continental have all announced similar restructuring plans. The ripple effects extend far beyond Germany's borders. Poland's economy, deeply integrated with German manufacturing supply chains, contracted by 4.2% in the second quarter of 2025. Czech automotive suppliers face bankruptcy waves as German demand evaporates. The entire Central European manufacturing ecosystem, built over 30 years of integration, faces existential threat as its anchor economy unravels. What terrifies the Bundesbank most isn't just the industrial decline itself, it's the speed. Economic transformations that typically unfold over decades are compressing into months. The bank's models, refined over generations, prove useless against this velocity of collapse. Historical parallels offer little comfort because nothing comparable exists in modern European history outside wartime destruction. The banking sector. Time bomb. Hidden losses beneath polished surfaces. Europe's banking sector carries vulnerabilities that make 2008 look manageable by comparison. The Bundesbank's Financial Stability Report from September 2025 identifies over 800 billion euros in potential commercial real estate losses across European banks. These aren't theoretical risks. These are concrete losses accumulating as office buildings in Berlin, Frankfurt, Paris, and Milan sit empty, their valuations plummeting while loan obligations remain fixed. Deutsche Bank's third-quarter results revealed 14 billion euros in commercial real estate exposure, requiring immediate revaluation. Commerzbank faces similar pressures. Italian banks, already fragile after decades of bad loan accumulation, show commercial real estate portfolios that may require government intervention to prevent collapse. The European Central Bank's stress tests, conducted in mid-2025, used assumptions that the Bundesbank now considers dangerously optimistic. Residential mortgage portfolios present another concealed catastrophe. Interest rates, held elevated to combat inflation, have pushed millions of European homeowners into negative equity positions. German property values declined by 18% since their 2022 peak. In some regions, the decline exceeds 30%. Variable rate mortgages, common throughout much of Europe, have seen monthly payments double or triple. Default rates are rising across all major European economies. The Bundesbank identifies a particularly sinister dimension to the banking crisis. The interconnectedness problem remains completely unsolved since 2008. European banks remain massively exposed to each other's balance sheets through complex derivative positions and interbank lending. When one major institution faces serious trouble, contagion spreads instantly through the entire system. The bank's confidential scenarios model what happens if just 2 of Europe's 20 largest banks face liquidity crises simultaneously. The answer: potential systemic collapse within weeks. What makes this banking vulnerability especially dangerous is its interaction with sovereign debt problems. Banks hold enormous quantities of government bonds on their balance sheets. As fiscal pressures mount across Europe, sovereign debt becomes riskier. But banks can't dump government bonds without triggering market panic and destroying their own capital positions. They're trapped, holding increasingly questionable assets they cannot sell, funding positions with increasingly expensive deposits they struggle to retain. The fiscal catastrophe. When mathematics overwhelms politics. Germany's federal budget deficit reached 6.8% of GDP in 2025, shattering the country's constitutional debt brake and decades of fiscal orthodoxy. The Bundesbank's projections show this deficit expanding to 9% by 2027 without radical policy changes. These aren't temporary COVID-era emergency measures. These are structural deficits reflecting fundamental misalignment between government commitments and economic reality. The numbers become truly frightening when examining the complete fiscal picture across Europe. Italy's debt-to-GDP ratio surpassed 154% in mid-2025, with annual interest payments now consuming 17% of government revenue. France faces similar trajectories, with debt service costs rising faster than any other budget category. Spain and Portugal, briefly celebrated as reform success stories, find themselves sliding back toward fiscal crisis as economic growth evaporates and unemployment rises. The Bundesbank's most alarming assessment concerns pension obligations. Germany faces unfunded pension liabilities exceeding €2 trillion over the next 3 decades. The ratio of workers to retirees continues deteriorating as birth rates remain catastrophically low and population aging accelerates. France's pension system, already requiring massive government subsidies, faces insolvency by 2028, according to updated projections. Italy's pension spending consumes over 16% of GDP, a proportion that will rise as demographics worsen. Healthcare costs present another fiscal nightmare. Germany's healthcare expenditure is projected to increase by 40% over the next decade as the population ages, and medical technology costs escalate. Every major European economy faces identical pressures. These aren't discretionary expenses that governments can easily cut. These are legal entitlements embedded in social contracts that define the European model itself. The Bundesbank's confidential memorandums to the German government outline an impossible trilemma: maintain social spending commitments, service existing debt obligations, and preserve investment in critical infrastructure and defense. Choose any two. You cannot have all three. But European politics makes choosing politically impossible. Any government attempting serious entitlement reform faces electoral annihilation. So deficits expand, debt accumulates, and the day of reckoning approaches inexorably. The geopolitical reckoning, Europe's vanishing strategic autonomy. The final dimension of the Bundesbank's alarm concerns Europe's deteriorating geopolitical position. Economic weakness translates directly into strategic vulnerability, and Germany's central bank recognizes that financial collapse and geopolitical irrelevance form a unified threat. Europe's defense spending remains wholly inadequate despite modest increases following Russia's invasion of Ukraine. The continent cannot defend itself without American military support, yet America's attention increasingly focuses on China and the Pacific theater. Energy dependency, the crisis that triggered Germany's industrial collapse, remains largely unresolved. Europe still imports massive quantities of liquefied natural gas at prices that destroy industrial competitiveness. Alternative energy sources develop too slowly to fill the gap. The Bundesbank's analysis shows that energy import costs will drain over 400 billion euros annually from European economies through 2030, a massive wealth transfer that permanently impairs European living standards. China's economic relationship with Europe has fundamentally shifted. Where German exports once flooded Chinese markets, Chinese electric vehicles, batteries, and solar panels now threaten to devastate European manufacturers. The Bundesbank notes that Europe risks becoming economically colonized, reduced to a market for Chinese manufactured goods while European production capacity withers. This isn't abstract economic theory. This is observable reality as Chinese firms establish dominant positions across multiple sectors simultaneously. The immigration and demographic crisis compounds every other challenge. Europe's working-age population is shrinking precisely when enormous investments in energy transition, industrial modernization, and defense rebuilding become urgent. The Bundesbank's models show that without massive immigration or miraculous productivity gains, European economies cannot generate sufficient growth to service existing obligations while funding necessary transformations. Yet immigration remains politically toxic across most European countries, making the necessary solution impossible to implement. The secret of Berlin's panic. When solutions vanish. What truly drives the Bundesbank's unprecedented alarm isn't any single crisis element. It's the realization that traditional policy tools no longer function. Monetary policy reached its limits years ago, with interest rates caught between inflation control and financial stability concerns. Fiscal policy faces mathematical constraints as debt levels approach sustainability limits. Structural reforms, even if politically achievable, require decades to produce results. Europe lacks decades. It may lack even years. The secret discussions in Berlin reveal something rarely acknowledged publicly. German policymakers see no plausible pathway to avoid severe economic contraction and social disruption. The best-case scenarios involve managed decline, gradually adjusting expectations and living standards downward while maintaining social cohesion. Worst-case scenarios involve financial crisis, political fragmentation, and the potential dissolution of the European Union itself as member states pursue divergent survival strategies. The Bundesbank's final alarm represents a fundamental admission. The European economic model, built on cheap energy, export manufacturing, generous social welfare, and geopolitical security provided by allies, no longer functions in the current global environment. Every pillar supporting European prosperity has cracked or collapsed. Rebuilding requires resources, time, and political consensus that Europe may no longer possess. The institution that guided Germany through reunification and the euro crisis now sounds warnings because it sees no clear path forward, only gathering darkness as interconnected crises feed upon each other, accelerating toward an inflection point where system stability can no longer be maintained through conventional interventions.